In this week's video, we'll review the latest charts to help us answer the question, which comes next, new all-time highs in the S&P 500 or a recession? Since the present-day charts and the historical analogies were telling us to be open to a 4 to 10% pullback in the S&P 500, and we had a gap that we were watching at 2744, it might be helpful to know that that gap did hold. Monday's close was the low for the week. We closed at the bottom of the gap at 2744. And the total for the correction to date, 6.84%, not materially different from expectations on May 20th, and very much in the ballpark with this historical study that we completed a few weeks ago. In recent weeks and months, we've seen some weaker economic data, which is bringing the Fed into the stock market equation with a little bit heavier weight. Ultimately, market participants make the decision whether or not Fed policy will be effective. In theory, we have weak economic data. The Fed can cut rates. At some point, the market responds to it, but a tipping point eventually is reached before a recession and bear market where the data, and especially data looking out, so the anticipation of future data, starts to outweigh any potential benefits from Fed policy and or future rate cuts. Is there any way for us to monitor where we might be in terms of this bull-bear tipping point? The answer is yes. Let's walk through a few recent anecdotal examples. January 4th, 2019, which was a Friday, that's when the Fed did the official flip-flop relative to the message that was delivered in Q4 of 2018. When the Fed delivered that message, the morning of January 4th, 2019, the stock market responded with a massive rally. The S&P 500 was up 84 points on January 4th. Thus, logic tells us it's hard to make the argument that we're over here when the market is responding in such a positive manner to the Fed's shift. Let's fast forward to this week, Tuesday morning. This is a Bloomberg article here dated June 4th, 2019, 9:55 a.m. Eastern Time. Once again, Fed jawboning with friendly market comments. It's a 60-minute chart here. This is a 30-minute chart. These comments came in the morning, and the market once again responded very favorably. The S&P 500 on June 4th was up 58 points or 2.14%. Once again, making it very, very difficult to say we're on this side of the bull-bear tipping point in terms of Fed policy. Before the opening bell on Friday, June 7th, 2019, we had a weak labor report. There's a tweet, 9:05 a.m. Friday, thus before the market opened. Futures traders are now pricing in almost 3 rate cuts by December. Once again, giving us an opportunity to test and see if we're over here, possibly here, or over here. Difficult to say we're over here at this point with the S&P 500 rising over 1% on Friday, June 7th. Like anything else, we will continue to take it day by day. How about government regulation and or antitrust action relative to the big cap tech stocks or the leaders known as FANG? Wall Street Journal, June 2019. Some anecdotal historical evidence. Seattle Times article dated May 11th, 2011. Microsoft's antitrust troubles were first ignited in 1990. Here's a significant pullback in Microsoft that occurred in August of 1990. How did Microsoft do following the announcement of an investigation by the U.S. government? Point A is August of 1990. Microsoft stock has done exceedingly well despite a long battle with the government that did not end until 2011. How about IBM? The government filed a suit in January of 1969. IBM stock, 1969, point A. Was government intervention the end of IBM as we know it? The answer is no. The stock has done quite well since January of 1969. Moral of the story, while relevant, government intervention, regulation, antitrust cases, not necessarily showstoppers for big tech. The Internet ETF, ticker symbol FDN, has been showing relative weakness relative to other tech ETFs for several months. Therefore, we have avoided it. There are ETFs that have very limited exposure to FANG. A couple of examples: RYT, the equal weight technology ETF, and VGT, which is a Vanguard technology ETF. This week, those two ETFs outperformed the other major ETFs, most of them having a much heavier weight to FANG stocks. As we covered 2 weeks ago, the NASDAQ, the tech-heavy NASDAQ, even during the correction, advanced decline volume relative to the peak in 2007 and 2000 basically said the odds favored the NASDAQ eventually going on to make a new all-time high. That is to be determined. There are only a handful of fundamental data points that are particularly helpful and consistently helpful in terms of trying to forecast or understand the odds of a recession. One of them is the unemployment rate. This is a weekly graph of the unemployment rate dating back to 1985. You can see the unemployment rate ticked up in a noticeable manner right around the same time the 1990-1991 recession reared its ugly head. Very similar story in 2001 and 2007. Notice in each case, the unemployment rate on a weekly chart crosses over the center line on the Bollinger Band and eventually gets above the upper Bollinger Band, above the upper Bollinger Band, and above the upper Bollinger Band here. We had a weak labor report on Friday, June 7th. How concerning is the present-day look of this chart? Based on what we know today, the answer is not very concerning. The unemployment rate was unchanged in May of 2019, meaning there's no change on this chart. Given what we know today, the unemployment rate would have to exceed 4.09% to take on a look like this, or this. And this will be a variable number here because the upper Bollinger Band changes over time. Like everything that we cover in these videos, this simply speaks to probabilities. While it's possible that this chart will morph into a look like this, or this, for our purposes, the important thing is it has not morphed into that look yet. Another tool that's helpful relative to trying to understand the odds of a recession, the yield curve, particularly the 10-year relative to the 2-year. The 10-2 yield curve inverted in February of 2000, before the S&P 500 peaked in March of 2000. After this point here, really bad things happened in the stock market. The 10-2 yield curve was flashing numerous we should pay closer attention signals prior to the major stock market peak in October of 2007. Said another way, the 10-2 portion of the yield curve had inverted several times before the stock market peaked in October of 2007, and then really bad things happened. This is the same 10-2 yield curve looking back to the latter stages of 2018, and this portion of the yield curve has not been inverted since 2007. In fact, we made a low in December, a higher low, another higher low, a high here in December, a higher high, and we just made a new higher high on June 5th, 2019. There's nothing particularly magical about any of this. It all just speaks to probabilities, and right now, 10-2 inversion does not look imminent. We'll continue to take it day by day. Credit spreads help us monitor the health of the credit markets, or the availability of credit, which is directly related to the health of the economy and stock market. Credit spreads reached 21.82% at the maximum fear level in December of 2008. The relevant question for us in the present day: what number do we need to see over here, so out here, before really bad things happen, for present day concerns to increase? This is a noisy chart. We'll walk through it quickly. If you know your market history, September of 2000 is where the S&P 500 really started to tank. Credit spreads at 6.77%. Similar situation here. The market got ugly, S&P 500, after November 2007. Credit spreads at 5.75. May of 2008. This is the area of the counter trend move, and then the S&P 500 took a serious leg down between May of 2008 and December 2008. Credit spread 6.53. June of 2011, after this month, it got ugly in the S&P 500. July of 2015, similar situation, 5.36. The average and the median of the pre-S&P 500 plunge levels for credit spreads in these anecdotal examples. The average, 5.97%, the median, 5.75%. Also noteworthy, near the low in 2016, spreads got as high as 7.77%, telling us a number like this doesn't mean a 50% bear market is on the way. Similar situation here. Credit spreads hit 8.41% in September of 2011, and the stock market did quite well after this point. How close are we to 5.97% in the present day? Not alarmingly close. Something we have to keep an eye on. We're at 4.42%. You'll notice 4.42% really doesn't show up in any of these pre-plunge examples. Clients and regular viewers know that our approach is not really a forecasting approach. It's a monitor and adjust approach. We are not using this number to forecast. We're using this number to monitor the health of the credit markets, economy, and stock market. Here's a Market Watch article that talks about credit spreads and the yield curve. You can find it by Googling this title here. If you pause your player, you can read portions of the article here. If you follow the economy, you know housing has been a weak spot, and that can be a red flag in some cases. Housing held up very well in the dot-com bust bear market period. If we look at the relative performance of U.S. home construction stocks via the ETF ITB relative to the S&P 500, you can see ITB has been on a steady climb relative to the general market since October of 2018, telling us to keep an open mind about stabilization in the housing market and/or the potential for improvement. Remember in last week's video, we said the present day had a lot in common with this point here in June of 2016. Also noteworthy, June 3rd, 2016, so right in the same area here that we talked about extensively in last week's video, And of course, the May numbers are released in early June. Very, very disappointing labor report at this point here. And we know the stock market did very, very well walking forward from June of 2016, telling us to keep an open mind about better than expected outcomes, even with the weak NFP or labor report that came out Friday. We also have to keep in mind monthly labor report numbers, or NFP, are often revised significantly. Thus, we have to take this week's number and any release, somewhat with a grain of salt. In last week's video, we said TLT relative to SPY looked similar on May 31st to June of 2016, and this point here. From this point forward, TLT underperformed SPY. From this point forward, it acted as resistance. TLT underperformed SPY. We were in the same general area. Is there anything else that we can see, measure, and put in a model that tells us it might be possible for stocks to start outperforming bonds? The answer is yes. Posted on Short Takes. You can Google this title here or find a link to it in our Twitter feed. Very, very rare extended look on TLT at the end of May. Only a handful of historical cases going back to 1986. Bond performance looking out 90 days to 180 days, not particularly impressive. Over the exact same periods in history, stocks did quite a bit better. Once again, simply speaking to probabilities. In order to get our sample size up, we looked at cases that just had a monthly close above TLT's Bollinger Band. It took our sample size up to 51. And we also did an intermediate term case that had 18 historical samples. The results were similar. Stock market performance, historically, much more attractive from a probability perspective relative to bond market performance. These are the figures here that had a sample size, a historical sample size of 51. The next 30 days, stocks on average beat bonds by 1.47%. Over the next 2 years, stocks beat bonds on average by 20.28%. 2019 to 2021 will obviously follow a unique path. We are not forecasting here. We are trying to better understand what this extremely rare and extended look in TLT may mean. This just happened in 2019. These figures here simply help us understand probabilities in the present day. And from this extremely rare and extended look in the bond market, over the past 5 sessions, TLT underperformed SPY, Treasuries relative to the S&P 500, by 4.17%. We'll continue to take it day by day with an open mind about all outcomes, including something that doesn't look anything like the historical cases. Is there anything else that tells us the present day looks similar from a probability perspective to this attractive risk-reward period for the stock market, or June of 2016? S&P 500 weekly, RSI, resistance, 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 a bullish breakout. Often you come back, retest the previous trend line, successful retest, a successful retest here. From this point here, really good things happened in the stock market. You can see in the present day, we have a very, very similar look. What once acted as resistance, may now act as support. This is the look of the chart on June 6, 2019, telling us to keep an open mind about better than expected outcomes and new highs in the S&P 500. From this point here, the market went on to print a new high and then significantly higher highs. Based on all the data that we have in hand from the December 2018 low walking forward, the weight of the evidence favors the S&P 500 making a new all-time high sometime in the days, weeks, or months ahead. Let's assume, hypothetically, the S&P 500 trades above 3,000 in the coming weeks. It's important that we remain flexible under all conditions. Valuations relative to historical standards are extended. As we have covered numerous times in videos, valuations are a horrible way to time the market. However, common sense tells us if earnings growth is tapering off or we're in an earnings recession, valuations start to become more meaningful. It's much easier to pay up for a stock that's growing its earnings and is very, very healthy. Thus, if the S&P 500 does indeed go on to make new highs, and that's to be determined, something good probably has to happen on the trade front or in another area to enable earnings growth to get back on track, and that too is to be determined. We have a presidential election coming up in the U.S. It's fast approaching. Common sense would tell us that the present administration would love to get something done with China. Probably an understatement to say that topic is a wild card relative to future outcomes in the stock and bond market. If you've spent a lot of time studying historical charts as we have, you probably know that a short stay near a key area under a key moving average or a cluster of moving averages is often a bullish tell from the market. For example, you can make a case that as the market is falling here, some market participants are saying, if I see what I want to see, when we get near the 200-day moving average, I am going to buy. After Monday's low, we had a very, very short stay below the S&P 500's 200-day moving average. The longer that remains, the more it assists with bullish probabilities. Some anecdotal examples. Long-term consolidation, a retest, and a very short stay below the 200-day moving average. Numerous anecdotal cases here of relatively short stays below the 200-day moving average that were followed by better than expected outcomes. 1994, 1995, market was pushed below the 200-day moving average, a short stay here telling us to keep an open mind about better than expected long-term outcomes. Very similar situation here at the end of 1994. 1996, sideways consolidation for several months, a test of the 200-day moving average, a short stay, and good things happened. 2011, we have a breath thrust down here, shares a lot with the present day or the January low in the S&P 500. We rally off of that low, come back and kiss the 200-day moving average, a very short stay, and then good things happened. Another short stay here, and the market moved on to new highs. We have a similar look after a long-term period of consolidation in June of 2019. Obviously, if the S&P 500 gives up the 200-day moving average and or this cluster, then the anecdotal cases really aren't in play. Here's our 2016 case that we've talked about from numerous different perspectives. Rally off of a low, a short stay or a kiss, and then good things happened. If you're having trouble keeping an open mind about better than expected outcomes, you might want to Google this title here and find this MarketWatch article. A macroeconomic research firm that looks at investor psychology says, It's particularly odd now that there's been a big flight of money out of stocks to bonds. Based on their work, they see the Dow climbing to 30,000 and eventually to 40,000, which would represent a 56% gain from current levels. This analysis uses sentiment and/or market psychology. If we look at the American Association of Independent Investors sentiment poll, very, very similar look to these historical periods here. This is the S&P 500 on the bottom. Taken in isolation, this is not a timing tool. It just helps us keep an open mind about better than expected outcomes. And keep in mind, this number looks ridiculous. But the hard data that we've seen since the lows in late December 2018 tell us to keep an open mind about much better than expected outcomes. And we haven't seen anything yet that's out of line with these historical cases. As we noted before, the average between 4 and 10% is 7%. Market really hasn't done anything all that odd at this point. The pullback to date is 6.84%. And that type of pullback aligns well with many of the historical cases that we've covered, cases where really good things happened looking out 1 to 2 years. Remember last week we covered the 100-day crossing above the 200-day. Historically, 92% of the cases were higher 2 years later with a median gain of 23%. The Bollinger Band study that we updated last week also tells us to keep an open mind about better than expected outcomes looking out 2 years with a median gain of almost 30%. Based on what we've seen so far, we're still in between 4.29% and 9.94%. And we have to keep in mind we still have the favorable look relative to the 200-week moving average. And the present day look really doesn't look anything like this topping process here or this topping process here. In the present day, we went down to the 200-week moving average and bounced. It's not what happened here. It's not what happened here. These are very, very tepid moves above the 200-week relative to the rare breadth thrust that we experienced in early 2019. And yes, some portions of the yield curve have inverted. We've covered that topic in the past. You can find it by Googling this title here. And history just doesn't align with the narrative that says when the Fed starts cutting rates, really bad things happen in the stock market. Fed cut rates 3 times in 1995, early 1996, and really good things happened in the stock market. In this area here, we already have yield curve inversion and good things happened, simply telling us to keep an open mind about better than expected outcomes. These green lines here helped us monitor the current pullback, percent of stocks above their 200-day moving average. May 31st, we came right back into the green cluster of lines here and bounced, telling us that what's happened thus far does not look materially different from 3 historical cases that are very, very similar to what we saw in this area here and during this pullback. It's also noteworthy. The S&P 500 came back to the area right around the 38.2% retracement and rallied. Inflation numbers have been weak. And if you know the Fed does not want to see inflation get too low, telling us 1 to 3 rate cuts is well within the realm of possibility between now and the end of the year. We'll close with this. 2 wonderful developments this week. June 7th, 2019, weekly chart of the S&P 500. This is a wonderful looking high-low closed bar. It's known as a bullish outside reversal. This week, intra-week on Monday, we exceeded last week's low, and then we closed above last week's high. If we look at the candlestick, there's wonderful buying power in this move here. This is volume by price. You can also see here, this is the volume spike area here at these S&P 500 levels. The S&P 500 came right back to the important area here and thus far has held. We purposely avoid forecasting. Forecasts bring egos into the equation. Thus, it's best for us to take it day by day with a flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.